Hey traders, why should you trade at all? Why not just buy and hold? I'm champion trader Kevin Davey, and let's find out. A while back, somebody commented on one of my YouTube videos and said, hey, instead of trading, why not just do buy and hold? Hey, that's a fair question. And for a lot of people out there, I'll tell you what, it's probably better just to buy and hold. And don't worry about trading. But for those of you who like the puzzle of trading and like the ups and downs, trading could be for you. Now, let's realize that buy and hold pretty much only applies to the stock market, right? That's something where all of us do it in our retirement accounts and 401ks. We're all invested in the stock market, right? But a lot of other markets, especially in the futures world, aren't really buy and hold. Now, maybe you could argue the U.S. bonds, the 30-year bonds, hey, that probably was a good buy and hold market for a lot of years. But you look at something like crude oil or gold, those aren't going to be good buy and hold type markets. Now, you might want to hold gold as an inflation risk, but realize there's some big ups and downs in gold. So those really aren't buy and hold, but the stock market is. So the question is, why trade in the first place? Why would you want to not just do buy and hold and just get the average of what everyone else is getting? Well, the first reason you might want to trade instead of buy and hold is you have the potential to make more money. So you have the potential to do better than average. Of course, the downside is you might do worse than average, but at least the potential's there that you could make quite a bit more and quite a bit better return than buy and hold. So that's the first big reason. The second one is risk. You know, the stock market's had some pretty big crashes over the years. I can think of 2008, 2009, the financial crisis. That was pretty bad. A lot of the younger traders out there don't even realize that happened. They never lived through it. 1987 was another bad crash. I remember I was out in the working world at that point, and I'd always see these old guys walking around. They look like zombies. And I asked somebody, what was going on? And this was mid-1988. And they said, well, hey, those are all guys who were going to retire at the end of 87. But when the stock market crashed in 1987 in October, they realized they had to keep working. So they're not happy people. And, you know, you could look at them and you could tell they were just zombies, man. They were just walking around like the Walking Dead, because they were trying to make back some of that money they lost. And eventually they would have, but it just took a while. And then, of course, in 2020, we had this COVID crisis in March, April, and people thought the world was going to end, and the stock market along with it. So that wasn't a really good time to buy and hold either. So there is a lot of risk in buy and hold. And if you have an algo that goes long and short, you can actually benefit from the short side. Now, it's not so easy to build these algos, of course, but the possibility is there. Then another big reason why you might want to trade instead of buy and hold is ego. Hate to think about ego and being involved in trading, but it is. And there is a rush that you get when you create an algo that makes money and does better than average, does better than the buy and hold. Anyone can do the average just by investing in SPY, right? In the SPY ETF. But if you create an algo, you can do a lot better. And that's kind of a neat feeling when you do that. What does buy and hold look like over the past 6-7 years or so? Here's an equity chart with it. And you can see there's been some scary drawdowns. There is risk with buy and hold. Now, a lot of times it's hard to see what the risk is other than looking at an equity curve. So I use my Monte Carlo simulator. You can get it free off my website. And it helps you determine your risk for your return. And it incorporates all the trades that you've made. So it incorporates all the drawdowns, all the potential drawdowns, if you mix up the trades. And it gives you a risk-adjusted return. And that's what I use to compare trading systems. With this one, with buy and hold, it's okay. It's not that great, but you still make money. On a risk-adjusted basis, it's just not stellar. Let's look at some algos. How can you improve it? Well, the first way is a free algo. Go to my website. You can download it, get it for free. Well, you basically give me your email, so I guess it's technically not free. But this is what that algo looks like. Now, it has drawdowns, so it's far from perfect. But on a risk-adjusted basis, it's better than just buy and hold. And when you compare the equity curves, you can see it's definitely better than buy and hold. The drawdowns aren't as severe. The equity curve's a little bit smoother. So, right there, you can beat buy and hold. Here's another algo that I actually trade. This one is a lot smoother. It's eliminated a lot of the drawdowns. And on a risk-adjusted basis, it looks even better than the first two. The problem is it just doesn't make as much money. But if your interest is really risk-adjusted return, you can always use leverage to trade more contracts. Here it is when I trade two contracts, two ES contracts, compared to trading one of the other ones. But you can see it's a lot smoother equity curve, so the drawdowns aren't as bad. And that's what you're kind of aiming for when you're building an algo. You want a nice smooth equity curve, because buy and hold, that has a lot of drawdowns, and that's what you're trying to avoid. Here's one more algo. This was actually created by a student of mine, a Strategy Factory Workshop student over in the UK. And this one, when he submitted it first to me, I thought it looked too good to be true. It just is an awesome looking strategy. So I've been watching it for quite a while now, and it's continued to do really well, as you can see here. So it's a really nice strategy. And when you compare it to the other strategies, it blows them away on risk-adjusted return. And you could actually get the same kind of overall profit by trading 3 of the micro ES. So a lot less risk to get the same return. And it's a very smooth, nice-looking equity curve. So that's an example of what you can do with algos. So right there, I've given you 3 examples of algos. They are all created using the Strategy Factory approach, which I use and what I teach. And you can see in this table that your risk-adjusted returns are better. A lot of times your max drawdowns go down. Certainly your average drawdown, which I don't have listed here, goes down because you have smoother equity curves. So the answer to the question is, can you do better than buy and hold in the stock market? If you trade ES, you sure can if you create the right kind of algos. Now, this is all hypothetical, of course, and you can do worse. That's why you have to create the right kind of algos and create them properly. Most people just optimize and then start trading it, and that's just a road to disaster. So if you're going to create algos, learn the right way to create them. Good luck, and I hope it works out for you. So if you like this video, please give it a thumbs up. Please subscribe to my channel. I'll keep making videos. And if you have comments, feel free to leave them. I'd love to hear your thoughts on this. Do you think you can beat buy and hold? Have you created some good algos? Let me know. I'm Champion Trader Kevin Davey, and thanks for watching.